Hello folks, welcome back. This lecture is going to be titled Bridge Builders, and it's kind of built on the premise that what bridges the gaps in neophyte traders, new students that are coming to the channel that are familiar with typical analysis that's retail, but what makes it different here? Like, what is it that you should be trying to aspire to understand? Now, obviously, a lecture like this isn't intended to obviously do a compendium. Like, it's not going to be a be-all, end-all panacea. But if it's a conversation that you would have with me if we just met somewhere, perhaps in a cafe, we introduced ourselves, and through casual conversation, the idea of, what do you do for a living? And obviously, I've had that happen over the course of my life many times. You'd be surprised how many people really don't understand what it is that we do. And this is kind of like a discussion for the very brand new students that come to this channel. Now, some of you aren't going to learn a whole lot from this, the ones that have been here for a long time. This is going to be kind of like what you already know. Now, don't let that discourage you, because you might catch something in this teaching that you weren't expecting. I was going to do this in 3 sessions or 3 volumes, but after doing some outlining and such, I kind of streamlined it into this presentation here. So, bridge builders is kind of like the topic of what is it that you're going to be trying to do as a trader, as a student, as a technician. What is it that you're aiming to do in the marketplace? Now, the overview of this presentation is the theme of a bridge and the building of that bridge. Now, that's an analogy, obviously, but applying it to this presentation, in the first stage would be design, where you envision trade setups. Like, what does it look like? Because there's a lot of people coming to the channel all the time, over 350,000 followers on the channel now, which I'm absolutely humbled by. Thank you very much. What do these setups look like? And what's the inception and what's the terminus? Where does it begin? Where does it end? And loosely, that is the trade idea. So what is it you go into the charts looking for and hunting? That idea of a bridge will make more sense as we get further along in the discussion here, but the second stage of this presentation is framework. How do we frame trade setups? How can you frame a trade setup? And the understanding of redelivery and rebalance the price. So how do trades unfold? We'll talk a little bit about that as well. And the final phase of this presentation will be building. So the trade setups themselves, time frames and sessions, and where trades form. All right, so I want you to take a look at this depiction of a bridge. It's just simply a profile picture of a bridge. To be quite honest with you, I don't know what bridge this would be representing. It may not be a real bridge. It may very well be a bridge. I don't know. I just grabbed one off the internet to illustrate this analogy. So if we were to assume that you and I had just met, and I'm trying to convey the idea that what we're looking for as a technician, as a trader, a price action trader, we're looking for an opportunity where price is right now at the market and where it will likely be at a later time. Now, that later time is not imperative to know at the moment right now, because this is a casual conversation. But the idea is that we think that price is going to be from where it is right now to another price, higher or lower. Now, in terms of discussing this with the analogy of a bridge, obviously you would come to the conclusion that if you were on the left-hand side of the bridge and you were wanting to go to the right-hand side of the bridge from this perspective, the beginning of the move, the origin, or wherever the market price is right now, that is the inception of the move. And where you're trying to get to the other side of that bridge, or where price is likely to go to in the future based on your assumptions and your analysis, bias, that's terminus, where that ends. Now, in between both sides of this bridge, moving left to right, there's a lot of things that take place on that bridge. Vice versa, if you're on the right-hand side of the bridge and you're trying to go to the left-hand side, the right-hand side would be the origin of where the market is right now, or the inception of the price move that you're trying to capitalize on, and moving to the left side of the bridge. That would be where terminus resides, or the end of the move. Now, obviously, much like this bridge would represent here, if you were on either side and got to the other side of the bridge, it doesn't mean it's the end. Obviously, the road would continue into another direction and maybe branch off in other directions, much like the market would as well. But we're only looking for a snapshot in price action, a right now moment, something to capitalize on where we can frame it with this logic in mind. Now, perhaps you've had the pleasure of sitting in traffic on a bridge. I have had the unfortunate experience of sitting in New York traffic on the George Washington Bridge, on the Verrazano Bridge, and it's a little unnerving, and it was usually when they were doing construction. When you're on these bridges, and I know some of you are like, get to the point. If you're that type of student or that kind of viewer, I suggest you don't even follow this channel, because I like to go into detail, and they are needed details, because the world today is thinking that everything should be done in 144 characters, okay, or in 20 seconds, and you can't learn this in that little bit of time. So do yourself a favor, go watch somebody else that thinks they can condense all this stuff in 5 minutes. You're not going to learn it all there. You'll be back here, but just know that you can't learn it quickly. But if you're on a bridge like this and you're going through a construction zone, there's a lot of activity going on. And you may have to change lanes. You may have to move into one single lane where it would usually be 2 lanes. Those detours, those deviations from what you would expect, or what would otherwise be a very smooth transition from one side of the bridge to the next, that's what a reasonable assumption would be. But traffic, much like market volatility, presents its own deviations, detours, and delays. So it's a matter of understanding that where we are on the marketplace relative to the time frame you're looking at, that might be a daily chart, it might be an hourly chart, it might be a 15-minute time frame, it could be a second chart, 15-second, 30-second chart, 1-minute chart. Whatever that time frame is, you're looking for that bridge from where price is right now and where it's likely to go to next. You're not trying to hold on to a 10-year move. You're not investing, okay? I don't teach investing. I think that velocity is the answer, and you can take a small amount of equity and parlay that up with velocity. That means getting in, getting out, getting in, getting out. Now, you have higher transaction costs with that, admittedly. I wouldn't argue that. But in the hands of someone that is versed with sound logic and price action concepts that I'm sharing, the potential is there for you to outpace the costs of commissions and fees that would be associated with your trading. Not everyone is going to have that result. There's a lot of growing that has to take place, and I am always doing my utmost to prevent myself from presenting it as a sugar-coated approach to going out and making quote-unquote money. But the skill set of understanding where the price is right now and where it's likely to go to, that framework is how you're designing your understanding that repeats over and over in price charts and studying price, these phenomenon repeat. How many times have you seen a bridge that looks exactly like the last few that you've seen if you were on a road trip? They don't really look alike, but they do the same thing. They bridge one point to the other. They look similar in some ways, but they're not identical. Just like every time you get into a trade, it's going to look familiar. This is where price is. It's probably going to reach to that pool of liquidity above an old high or below an old low. So you can envision that idea. That trade idea, you can visualize it by looking at price. You only understand that by going through old price data. So we study price data, we look at charts, and because of history repeating itself and the fractal nature of price action creating these similar patterns that repeat on all time frames, that's the premise that we go into. Old chart data, hindsight moves. So it teaches us what the framework is likely to be after we understand how the trade itself is envisioned. So if we're looking for something that's bullish, we're naturally going to be assuming that the market's going to be moving from where the market is right now at market price to a higher level or a higher price. The idea of being able to see or envision the trade setup is going to be hinging directly on how much time you go into old price moves and study them in detail. Not just casually looking, oh, it moved this much money or this many pips or this many points or handles in the index futures market. You want to know all the details. What day it took place, what time of day, what month, how many points did it move, how much drawdown did it have, and what's the characteristics of that type of move, and was there a high impact or medium impact news driver that come out around or just after or before that move began and where it ended. So that data that you're collecting that provides you a foundation, a pseudo experience. You didn't take those trades, you can't go back in time, but it allows us to digest that material and place it in our understanding so that way we can start watching price right now going forward with a forward testing. Now, when we're looking at price data, there are things in price that you've learned from me here that are inefficient. Now, inefficiencies, if we're going to be using the analogy with the bridge, a bridge is not built from both sides at the same time without the same plan. Otherwise, you'll get results like this, where they won't meet in the middle. But the market many times creates this very situation just like this. This, to me, very closely represents a gap, a volume imbalance, or a fair value gap. Those three things, I can see that in this quote-unquote analogy in a improperly built bridge. Now, they both have a origin or inception of the move, whether it be the right hand or the left hand side of the bridge. And the opposite would be terminus, where the move that you think would be likely completed, the target, or draw on liquidity. Now, you might not understand inefficiency in price. I'm going to cover a lot about that very thing tonight, but it's still only scratching the surface. It's a very deep subject, and I promise you it goes much further than what would be understood as a commonly referred to as liquidity void. Okay, that's tossed around rather loosely without really understanding deeply what it is that entails. Now, sometimes when there's a gap in price, the market itself, the algorithm, will return back to those areas and revisit them. Now, that might be a fair value gap. It might be an actual gap where there's a session ending and a session opening. For instance, we're trading the index futures market. They close at 5 p.m. in the evening time in New York time, and then they reopen at 6 o'clock. So there's an hour lag where there's no trading. That creates opening gaps sometimes. So that's a real gap. Sometimes intraday you may get a gap because of news or some unannounced geopolitical event, and that creates a real void in liquidity. That means there is an absence of any trading. Okay, the word void, when it's associated with liquidity, implies that there's absolutely no trading there at all. When we have a fair value gap or a volume imbalance, there's a specific void of a specific type of liquidity. And I'll touch on that when we get further in the lesson. But when we have an actual gap, when there is no trading, that's usually seen with session opening and closing, or weekly openings, where there's a gap between where it closed on Friday and where it opens on Sunday. So that weekend gap, or we commonly refer to as a Sunday gap opening, many times that is formed because there's a imbalance created at that opening. That imbalance or inefficiency creates an actual gap where there is a real liquidity void. There's an absence of both buy side and sell side. No trading took place at all. So the market likes to draw back into those areas and use them as a means of recapitalizing and finding fair value, and then it can continue on in the direction it gapped, or it can trade beyond the gap and come back and treat it as a support or resistance. So we have efficiencies in price when the market returns back to these inefficient price points, that being the gap, the fair value gap, or the volume imbalance. So when I'm looking at price, the first thing I'm looking for is where is it likely to go? What's the draw on liquidity? Because if I can understand that, then I know I have framework for a trade idea. I can build a bridge from where market price is right now to that draw on liquidity. Now, here's the wonderful thing. And this is what many of the new students that come to my fold find themselves stuck in. They think that the draw on liquidity must be traded to, or it's a failure. So it's a all in and collect everything at the target, or failure. Because they've listened to other people claiming to be a mentor, claiming to be a profitable trader, claiming to be 20 years in the business, or whatever it is that they say. And they give terrible advice about how you cannot do well by opening yourself up to a measure of risk, and then as the trade moves in your favor, take partials along the way, because the assumption is that your trade is a losing trade. So therefore, you're going to get the maximum loss. I have lessons on how we can mitigate some of that. Not all the time. I mean, there's times where I get a full stop out, and it happens, folks. It's going to happen to you too. But the things I teach in terms of characteristics and price action, those things will many times tip you off before the market really does the majority of the damage that would be available to the stop loss being hit. In other words, if you open up a trade, whatever that maximum stop loss is at the time of entry, we don't keep it there. And it's not going to stay the same measure of risk through the life of the trade, especially if it starts moving in a direction where it allows us to take partials. Because every time you take partials, you're building your bottom line and you're reducing the open risk in that specific trade. So when new traders come to me, many times their mindset is fixated on how much they can make, when I want you to focus on how much risk is there, how to control that risk, manage the risk, and if you can do that well, money can deposit into your account as a default. Now, it doesn't mean it happens by magic. You have to understand how to manage a trade. You have to be able to pick the right direction. You have to be able to time the trade. All those factors come in, and I teach all that on this channel for free. But new students come to me, and they come in with really bad habits or expectations, and grossly unrealistic expectations. They want to be able to take a $100 account and turn it into $5,000 in a month. I'm not promising you're going to be able to do that in the first month learning here. Okay, so don't ever think that's not likely to happen here. Now, can you do something like that with years of experience based on the things I'm teaching? I believe yes, but it's going to take a lot of work. I don't want to give those types of expectations out, but I want to remind you and ground you right away, especially if you're new. These types of ideas, like I mentioned in the title, that this is a bridge builder. This helps you understand what it is that you're trying to do with the information I teach on this channel. So when we see price return back into these gaps, into these volume imbalances and or fair value gap, that creates efficiency in the delivery of price. Then the market is more free to move in the direction it was going in prior to returning to the inefficiency. So the market's always going to seek fair value, efficiency, and yield. Think about what I just said now. It's always going to seek efficiency. That means it's going to go back and redeliver. What does that mean? Price will go back up to an area where there is an inefficiency. That is a redelivery. That is not price being rebalanced. That's a misnomer. And this is not a knock against Mr. Chris Laurie, but I've never liked his definition of that being rebalanced. That's not rebalance, that's redelivery. And I'll show you exactly what rebalancing in price is. When there is a gap in the form of a fair value gap or volume imbalance, when price goes back up into that or down into that in deference to when it's bullish, it returns back to that area and reprices to it. And it allows inefficiency in market price delivery. Now, once that happens, that may or may not be a trade. It may be a reason for you to trust that the trade that you're in should move in your direction now. I many times use it as a way of pyramiding. So in other words, I went in with, say, 8 contracts on the S&P. I'll go in and add 4 more at a period of where the market goes back to an old inefficiency. And then when it does that and reprices to it, now it becomes efficient. Then the market is allowed to be delivered in the direction, hopefully, in my trade. So if I see that as an opportunity, I can pyramid and build my position larger. And every time it does these types of things, I can build a larger position and therefore make more money in the trade. Now, if I'm wrong, it just means that I'm assuming more risk and I have to manage it a little bit differently. But larger positions obviously bring with it larger risk. And that obviously requires more experience. And if you're new, you don't have that yet. And just because you watch my videos, it does not mean that you can do it too. You have to do a lot of studying, a lot of practicing, and it's a skill set that is derived from doing a lot of things that are going to feel counterproductive. But it's like anything else that's worth doing. If you want to be a doctor, you want to be a fighter jet pilot, you want to be an airplane pilot, these things require a great deal of study and practice and case studies and just honing that craft. And this is extremely technical, and you have the problem of your personality and your impatience standing in your way. But when you have these specific things in price, looking at it over time, you'll be able to push those bad habits, those character flaws that is existing in every one of us. I have character flaws. I'm bipolar. And all these things, and I'm a perfectionist on top of it. So I have a lot of things that go against me that I have to wrestle with. You're going to have your own things too. And you don't many times know what they are until you start trading. And until you observe and journal what it is that you're feeling emotionally, psychologically. What were you stressing about? What did you feel overconfident about when you went into the trade? What did you see? And the reactions after the trade either comes to fruition in a profit or stop out. You have to record all those things, and you have to do it for as long as you're a trader. I still do those things, and I'm about to be in the business 30 years, and I still do this. It keeps you dialed in. It keeps you focusing on the right things and not deviating from the things that you've grown to understand and trust as a technical trader. All right, so with all the boring preamble, of the way. I know some of you will just scroll through the video until you see a chart, and then that's where you'll stop. But you won't learn what it is that you should be learning here if you do all that stuff. And that's why I also delete people that make a comment, and I don't really let comments anymore, because you can see it's been a sugar fest since I've been doing it. But I don't like when people say the video begins at this minute mark. You're cheating people from understanding what the premise of the video is. There's a monologue there, yes, but it's to get your expectations in alignment for what it is I'm trying to teach. Here we have the December contract, the S&P for 2022. And I want you to take a look at price, and I want you to find what you think is the dealing range for this particular time frame. Now, don't be upset if you get it wrong. Okay, you see that high right there? Why am I picking that high? We had a low that was broken. We came back up into balance. This low to this high, that is a fair value gap. This is a volume imbalance. There's two of them here. Price trades up into that, and then it's allowed to go lower. I'm using this candle here because it's the high between this candle's high and this candle's high. So it's a swing high. 3 candles. You don't need 5. If you're waiting for 5 candles, you're going to miss the move. Okay, so we don't use Williams fractals. Swing highs and swing lows are simply just 3 candles. Okay, 1 candle in the middle, lower high to the left, lower high to the right. That's a swing high. A candle in the middle with a higher low to the left and a higher low to the right is a swing low. Very simple. Now, the dealing range low is down here. Now, why? Because we had the market trade multiple times lower, and we went into a higher time frame area where we mentioned that it was likely to have a bounce. And I'm going to refer you back into Twitter, and around this time you'll know that we were expecting some bit of a bounce. Eventually, the market on this particular day had a up close, and we were likely to see this high taken out. Draw on liquidity is the here, and should it trade higher to at least equilibrium to this high and that low, and the way you find that is to simply put a Fibonacci retracement from here to here and post it with the 50% level. So we want to see price try to gravitate back to 50%, which is equilibrium, and or preferably higher. That would take us into this volume imbalance right in here. Okay, so the volume imbalance is where there's a body in one candle and a wick that closes or bridges the gap that would otherwise be there if this wick didn't exist and this wick didn't exist, and they just had this candle's body and this candle's body, there'd be a gap there. Well, because there's a wick here and here, this is a volume imbalance. That's inefficiency. So the market will go back algorithmically back to this area. So we note that here, and that is a premium array. From high to low, half that move was about right here, and it's above 50%. So this is definitely a premium level. So it's going to be a draw on liquidity. So the next day, you would be expecting price to likely trade at least to this high and through it. And if it continues the very next day or the next day or along the course of the week, you would try to see if it's going to trade up into this area here, and then maybe reach into this fair value gap there between this candle's low and this candle's high. So what this is noting is internal range liquidity. What does that mean? From this high to that low, I don't need this to trade above this high to find a trade. So if it's going to draw back up into this area here, this is internal range liquidity. It's going to run up into this area, and it's going to act as the terminus from the move from here that I don't necessarily have to be a part of, but at this candle's close, before 6 o'clock on the next trading day when it opens up again, I know that I'm likely to do what? Draw at least to this level here, that's near term, and then here. It's going to reprice back to that level. Why? Because we've already seen multiple times go lower, and this candle has really shown a willingness to want to reverse. We don't know that yet. We want to see how it opens the next day. So from this low to here, this is how we're building a bridge. From this low to here, That is a bridge. Thinking of it like an analogy. This is where the market is, and where it opens, it's going to move to this level here. It may take more than one candle or more than one day, but that's the logic. So here is the inception of the move, and terminus would be here while it's bullish. But when it gets to this level, then I'm going to look for evidence that it's likely to do what? Reverse. Why? Because the market's bearish. There's nothing bullish about stocks right now. Okay. So all this is going to be is a small little bounce, which is kind of like what I was building up as we were dropping down. It's likely to build a bounce in the marketplace. And that doesn't mean creating a low or a bottom. It just means it's going to reverse short term, run some stops, return to fair value. Not that this is a fair value gap, but this is fair value if it goes back up into here. And it's inside the range from this high to that low. I do not need to see this high taken out to find a trade or frame a trade. And when it gets here, I'm already expecting the likelihood of maybe trading up to here, but then I want to see the long-term trend resume, because seasonally speaking, the tendency is for the market still to continue lower. And nothing right now is bullish in stocks. It's horrendous right now. So the likelihood of lower prices is favorable, but I have to submit myself to the likelihood that the market can go up to this area here that's in orange, because this imbalance here in the form of a volume imbalance. There was trading. You can see it with the wick here and the wick here. But the bodies of the candles, I like to see them overlapping. Like this body here and here, it overlapped a little bit. Small little volume imbalance in here between the separation of that candle's close and that candle's opening. See that? That's a volume imbalance. And this is pretty much flush. I wouldn't look at that as a volume imbalance. But you see how this overlaps a little bit like that? And that meets it also here. So there's an understanding in how price is delivered when you look at price like this, not look at Steve Nielsen's textbook of supposed candlestick patterns. I have no faith in that, and I'm not trying to be disrespectful, but the market doesn't work like that, folks. Okay, it doesn't do that. It's doing what I'm showing you here. It's going to these areas of inefficiency and fair value, and it's seeking liquidity, period. Okay, so if we know that this is likely to occur, we submit ourselves to that idea. So what does that mean the next day's bias would be? Bullish. Once it gets to this level, I'm thinking longer term that it should trade below this low, make a lower low. And this would be external range liquidity. But that's outside the scope here. I want you to understand that we can work inside dealing ranges and never see those ranges broken and still find profitability. So what am I saying here? Once it gets to this area here, I can build another bridge, theoretically in my mind, that once price gets to this level here, market price would be in this range, right? Assuming that once it gets there, then I could frame the logic that we could see it trade lower. We could trade down to this bullish order block, and that would be a trade in itself. So from here, this would be what? The inception of the move to terminus. And it doesn't need to take out that low. This is very powerful, folks, if you really put some thought behind it, because 90% of retail traders are doing some kind of breakout strategy. This is not breakout. This is working inside of a dealing range, navigating an old range of data, not needing it to go out to new highs or lower lows. It's just working inside of an old range. The old range being this low and then high. So you can see once we got up here, the very next day, it was bullish. It opened, traded down, returned back to that candle's body or close. Created what? A volume imbalance. We'll leave that outside the discussion for now because I've already mentioned it in Twitter this morning, or I can't remember when I did it. It was either yesterday or this morning. I can't recall. But the market rallied, went into the volume imbalance. Look at the bodies of the candle. See how it's respecting this area here? This is redelivery. Okay. Then the market trades down, works into these last two down closed candles. That is a bullish order block. It does that. And then I wanted to see at that time, I wanted to see if it was willing to go above this high here to get into this fair value gap. It was unable to do so. That's fine. I was long. I took some profits. It was done in a live account. It's shared on Twitter. You can go look over there. Then the market did what? It repriced lower, away from the volume imbalance. Once it does this, it's pretty obvious what it wants to do. It's going to do what? It's going to draw back into this low to high. So this low to high, this is another new dealing range. I don't need it to trade below this low, but on this candle here, before this candle starts trading, it opens, returns back into this candle's close, volume imbalance. We are looking for price to go lower. The longer term trend or bias is bearish. So while I do submit that I believe that this low will be taken out, we don't need it to do that just for the sake of bias or building a bridge in price action theoretically. So from here, the inception of the move would be here to here, the order block. Okay, and you may not know what an order block is, and that's fine. But this is a foundational study. So it kind of like gives you a framework to go in and expect these types of trades, these types of frameworks, not buy, sell, like you see me do intraday like that. That's 30 years experience. I'm not saying that you're going to have that watching just YouTube videos. Okay. But these types of setups, I am confident that you can learn to do these, and they repeat a lot. And notice that we haven't even gone into the lower time frame intradays. We're not on a 1 minute chart where you see me thriving. You're not on a 5 minute, 15 minute chart, not even on an hourly, not even a 4 hour chart. We're still just on a daily chart. You can trade on this alone. You don't need to be in front of the charts or having to worry about your smartphone, keeping up with the marketplace, running your business, going to school, or working your job. You don't need to trade that way. And a lot of people come to me thinking, oh, I only learned how to do scalping at ICT, and I can't do scalping, so therefore his stuff doesn't work. That's not true. I teach literally every facet of trading, every way. I just prefer intraday because I can take a small amount of money and parlay that out really fast because I can find lots of setups that allows me to use compound interest and pyramiding. Whereas if I'm trading on a daily chart, the setups are far and few between. It doesn't mean that they're not good for you if this is what you have to do to find setups because of your life. Your circumstances don't permit you to trade with intraday. So don't view that as a weakness. There's always something to do, even on a daily chart. A weekly chart, if you're really just long term and it takes a whole lot of things for you to change your mind, you can trade off a weekly chart. I personally would drive myself crazy even trying to do that, but I have models that teach you to do that. It's simple. You apply everything you're trying to do in the lower time frame on that weekly chart. It's the same premise. Everything's there in that weekly chart the same way it's going to be in an intraday chart. It's just moving faster on a relative basis because you're looking at smaller time frames and putting large positions on. Whereas on a higher time frame chart, you're doing very, very small positions trying to capture big moves. So it's all relative. It's scalable. But you can't try to do more than you're comfortable doing because you will fail no matter what it is you're trying to use in trading. It may not be me that's the best mentor for you. Okay? You may not appreciate the things I'm teaching. You may find something else out there that's more appropriate for your particular personality. And even that could still be a failure in your hands if you're not lining yourself up with what is realistic. So hourly chart, here we go. Here's that volume imbalance on the daily chart. And we have a buy side liquidity pool. What is buy side liquidity? It is buy stops, basically pending orders that you don't necessarily have to see. Okay, I see all these guys out there saying, you got to use the DOM. Okay, depth of market. You got to look at the ladders and see what that looks like. And look, folks, all that stuff can be spoofed. I could put orders in there and pull them before it gets there. And that's what's going on a lot of times. Okay, so don't think that you're getting any special treatment, okay, from the marketplace because you have that. To me, it's a distraction. All I have to do is look at a price chart. And my students and we know where the stops are. We don't need any kind of technical gimmick. Okay, depth of market or whatever. We don't need that stuff. Just like we don't need market profile. And I know I'm sounding like I'm like talking down to those individuals that use that. And you might use it and you might be making money. But I'm not looking at those things and I don't need it. The things that you're looking for outside of price, the market has absolutely no respect of that stuff. It doesn't care. It's not even aware of it. The algorithm has no idea that your market profile, high volume, low volume nodes are even, it's not a thing. That's not a thing. Okay. Now, volume, when you're using volume profile, if you're looking for areas where it's very, very low volume and you have a fair value gap or a volume imbalance, that, my friends, here's that little gem I said, if you think you know everything, this might not be a video for you. That right there, that is a unicorn. Yes, 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 yes. Go into your charts and start looking at that. And then suddenly your volume profile will be a much more consistent animal for you. But strip it away, I could care less about your point of control. I don't care about that. I don't care about delta. Okay, I don't care about any of that stuff. Price is going to tell you everything you need to know as long as you understand the time. Because time is the first measure in algorithmic principles and theory. When is it happening or when is it likely to happen? If you don't know that, doesn't matter what you think you see in the charts, it isn't going to work. Period. I don't care who wrote a book, who did workshops, who does the teaching circuits, who goes to trading summits. I don't care if they like me or support me. I'm telling you, it is what it is. And I know that's what makes me polarizing, and it doesn't make me popular with a lot of folks, and it doesn't make a difference to me. I can make money doing what I'm doing here. My students are making money with this. They're consistently finding setups that make sense because it repeats, and it doesn't require any outside gimmick. It doesn't require any retail logic. And yes, depth of market is retail gimmicks. Market profile, retail gimmick. But they wrap it up in a perspective that it's what the big guys use. It's what these guys on Wall Street use. Now, there's a lot of people that use those things, okay? And a lot of guys on Wall Street still use moving averages, okay? I'm not a proponent for them either. But I'm showing you how price creates these opportunities where you can bridge where market price is now and where it's likely to go. Where should it go? See, DOM, depth of market, is not going to tell you where it's going to go with a high degree of probability. Because if that was the case, everybody using it on YouTube, I'm watching these fellas, they have no idea what's going on. They're asking each other. They're in rooms. They're in chat rooms. They're in Telegram rooms. What do you think's going to happen? What do you think about that price here? Oh, there's a lot of orders coming in around this price here. Means absolutely nothing. Means nothing. And they say, oh, you need to read the tape. And that's only done with depth of market. No, it's not. Reading price or reading the tape, that's defined in my fold as simply just watching real-time price book with no intentions of putting a trade on. So you're studying the ebb and flow, what price is doing on the candle. As each candle's forming, whatever time frame you're studying, you're getting experience watching that happen, moving from one level to the next. I'll outline it here for you now. So we had a pool of liquidity taken here when price ran above it there. So we moved just a little bit outside of that volume imbalance on the daily chart. Remember that orange shaded area? We went just a little bit above that and then broke lower. If you look real closely, you'll see there's a little swing low right there. Now, the model I taught on the YouTube channel is where we see a pool of liquidity rated. Once that liquidity is engaged, if we break down, why would we expect that? We went to a premium. In other words, it's an overbought market without an indicator. That's where this orange shaded area is. That's what represents overbought to me. I don't need an indicator to tell me that because I know how to read the dealing ranges. Remember the dealing range that I mentioned on the daily chart before we went down to this hourly chart? That range where we would trade above 50%, that's, in my definition, a premium market. It's overbought. It doesn't mean it can't go a little bit higher. It just means that by definition, it's overbought. But if we can frame it with time and price, we can expect the algorithm to start doing certain things. The market trades below that low here. So we have a shift in market structure here after buy side liquidity has been attacked. Now it's dropping. Well, wait a minute. Why is it doing that? Because everybody has a buy order that's trying to be a breakout artist. They want to buy that. They think it's, once it goes up there, it's going to keep going higher. That's not what we're expecting. And the market trades lower, and there's a shift in market structure here. Now everything technically is in line for lower prices. So your mindset should be any rally higher is a suspect rally. And if it can go into a logical level where we can expect to see it return back into, what would be the most logical price point? Going up to here, right? Because that's what retail resistance is. So look how nice and smooth that is. So the market should go right up there and touch that again, because that's what the textbooks say. That's not what happens. And we've already had a stop run on this high here. They shifted lower. Shift in market structure is seen with that swing low. That's right out of the model I taught for Mentorship 2022 on this channel. The 41 videos. Watch that. This is what's occurring right there. There is your fair value gap. It runs up into it here. Right in here at 9 o'clock in the morning. And then breaks lower. Sell side liquidity resides below here. That's sell stops. Anyone that's been going long, they show their stop loss right below that low. So this move from here to here, that's one bridge. That's one framework, okay? Or your first partial. If you're getting short here, you're looking to take first partial here. But then now what you're looking for is, what's the real setup though? If you're seeing this failed to go higher and it broke lower and it's a shift in market structure, and we're in a real premium market, really overbought relative to the daily time frame in that daily range, we can go back to this old low, can't we? I personally believe we're going to take that low out, yes. But again, with this teaching, I'm teaching you how to build a bridge and not need breakouts. 50% is about in here, and then below 50% would be right in this area here. You see that? That is a fair value gap. Buy side imbalance, sell side inefficiency. Now, you'll hear folks like Chris Laurie and folks that are familiar with him. They'll say that this is a liquidity void. It is, but what is it void of? Sell side. There's an imbalance, buy side imbalance. It's all one-sided bullishness between this candle's high and that candle's low. It's lacking sell side. So there's an inefficiency in sell side. There is no returning back down in to touch this candle's high. That would be efficient, but it doesn't do that at all. It just keeps going higher. Just like it does here. This is a fair value gap in the form of a buy side imbalance, sell side inefficiency as well. BISI, B-I-S-I. That's what I name it. That's what the algorithm sees. That's what it's doing, okay? How this gets returned to is it acts like a big magnet. So this candle is what color? Green. That means it's an up-close candle. So the market will be, while it's here, likely to draw back down into this candle, but do so as a down close candle. In other words, price will be offered inside the range between this candle's high and this candle's low in the form of down delivery, sell side delivery. You can see it here. But let's go back into all of this a little bit and bridge another framework between what we saw here and in this area here, not needing this low to be taken out. So we have a range between this low and this high. This run right here is a stop hunt. It's taking out the buy side here. So this move here, we can use that to do standard deviations. What does that mean? They're measured moves. That's all it is. A very classic phenomenon, the measured move. I didn't create it. I just know where to find the right ones. Okay, and then that's many times you'll see folks in the comment section of the videos that I do have open, or you'll hear people say things in videos that are commenting about me or doing reviews about what I do, and or they'll say things in my Twitter feed about how did you know to pick that swing high when you were taking that live trade, and how do you know that it was going to not do this, and how. First of all, it's experience, doing this a long time, but also sticking to rules. And also, here's the thing, sometimes, I know it's hard to believe, but sometimes I do get it wrong. And I learned from those mistakes over the last 3 decades. So it provides a lot of callous. I've learned and developed a lot of callous in doing what it is I'm doing here in price action. I know where I usually get hurt. And the things that would otherwise hurt other traders, I'm callous to it. So I'll hold a trade when it looks scary to other people. I'll buy when it's dropping. I'll sell short when it's rallying up. Many of you won't even do that because it feels scary. See a big candle, raging up. You're not going to sell short in that, but I am, because I know what I'm looking for. You don't know what you're looking for yet, but you will learn that if you study this channel. But this swing from this low to this high here, that run right there, that can be used as a swing projection. If we take that range low to high, duplicate that range from this low down. That's what this is here. That's a measured move swing projection. All it is this low to that high, that range, multiplied, doubled up basically, and projected below that low. So everything you see here on the upside, if you took that and anchored it to that low and projected it down, that's what I'm doing here. And without any other tools, look where it's lining up with the fair value gap. That's a confluence. Okay. Right away, I have enough to frame that bridge that if we go above here and fail below that swing low, I'm expecting something like this before it even happens. I'm looking for those things. I know some of you don't like to believe that, but look at the examples I put on my Twitter. They're live account trades, folks. I'm selling short the very high candle, and I'm buying the low candles. It's a real account. It's happening with a real account, and it's not always in a demo. So I've done that this year. I've shown you that I can do that stuff. You're seeing $10,000, $13,000 real hauls in profits. We're not talking about $25 wins here, okay? It's significant amounts of money. I'm showing you the logic. So we have a confluence of discount arrays. We have a swing projection that sends us down into this area here, and then it just happens to line up perfectly with a fair value gap. And it's below 50% of the run from the high to low. Well, the high to low here, rather. 50% is about right here, and below it would be here. And it's in a discount market. So we have a premium market. If we're going short, we're going to be aiming for something in a discount. The way we define that is what range are we in? We're in this low to that high. So split that in half, and then we look for something at that level or below it to aim for. We're using basic market structure theory here, and it aligns with the fair value gap. So if we have that, this again is once more a internal range liquidity. Reaching down in here, not requiring that low to be taken out, even though I personally believe it will. So we have that fair value gap here, and you can see how it handsomely trades down into that. So we can look at 36.45, we'll call that our level, okay? I'm ballparking, I might be a little off, but just for the sake of the discussion, 36.45 is the draw on liquidity. Best case scenario, we don't need that level to be traded to, but that's the best case scenario because that would probably be the high here, okay? So that's a nice confluence. So we're bridging this high to this area down here. So we have a beginning point and an ending point. So we're anticipating that. And I know you have the benefit and luxury of seeing this in the chart, but I'm putting it in this way so that way you can walk towards this understanding with everything in front of you. Because this is exactly what you're going to be looking at when you're studying old data anyway in hindsight. The charts are already going to be there. So don't be discouraged because I'm showing you and teaching you with the hindsight, because you can go over to my Twitter and watch me do it with live account. I'm doing it with live accounts. There's precision there. I've got scores and scores of demo trades. Okay, the logic repeats, folks. It's there for your learning. If you struggle with me not sitting in front of you with a live stream and telling you when to get in and get out, which I'm never going to do that. Never going to do it. Okay. I don't owe that to you. And I have students that are doing signal services. So if I'm doing that for you, they can't do anything. Why would they want to go and promote themselves and try to get a business started as my student doing those things? And then here I am as a teacher doing it for free. I would be undercutting them. And I'm not trying to do that for them. And plus, I already told you I'm not going to do that. I'm not going to spoon feed. I've given enough on this channel where all of you can quit your job if you just put the time into it. And yes, I said that. All right, so let's take a closer look into that little fair value gap right there between the high and the low here. It's going to draw back up into the area of inefficiency. So there's only one little candle from this candle's low and this candle's high, one candle range. That's what's shaded in pink, I guess. It goes right up into that. See how it does that repricing? That's repricing. That is not rebalanced. That's just a repricing back to an area of inefficiency. That does not balance that. Price moves lower. We're expecting it to move lower. If it takes out that low here, that's a first partial. You get that right here. Then we have another opportunity where price rallies again. Now this is non-farm payroll Friday, and I understand that this might not feel comfortable learning, but just take that out of the equation because there's other big moves that take place without non-farm payroll. This is a really nice directional play. This is classic delivery where if we weren't looking at non-farm payroll and it was just a nice, good, medium impact or high impact news driver for that day, it would look like this anyway. So take non-farm payroll out of the equation, even though it is, for disclosure, that's what this particular day is. All these signatures are there on regular days. So we have the inception of the move, or the beginning origin of the move, and we have the terminus based on everything I just outlined. It takes more time for me to explain it than you to spot it. If you do this work, studying old data, mark them up like this, okay? Try to figure out what it's doing in all the old hindsight moves. Pick a market you're going to trade. It may not be S&P, it may be NASDAQ, it may be Dow, it might be gold, it might be a crypto, it might be whatever, okay? Take the crypto out, I shouldn't have said that. I don't have faith in crypto, but I'm just saying that whatever it is that you're trying to trade, that one vehicle, that instrument, go back and start doing back testing. Start looking at old moves and study them in great detail like this. It takes a lot of time. Yes, it does. And lazy people will not be successful. I don't care if you're going to learn from me or not. Whatever you try to learn, you're going to have to do back testing. Whatever system that you're going to be learning or any kind of method out there, unless it's spitting out signals for you, which is stupidity if you do that. If you're trading something blindly, just taking somebody's, system that just tells you when to buy and sell, that's ludicrous to me. You have no idea what the logic is behind that. How can you trust that? How can you trust it? What's the rationale behind that? To me, it's never made any sense. Okay, but I'm certain there's people out there that will claim that it's profitable, and God bless you if that's what you feel. If you believe that, that's good. That works for you. It ain't gonna work for me, and my students wouldn't most likely subscribe to that either after seeing what it is I teach. But go through the process of annotating your charts like this, breaking them down. And again, we are on an hourly chart, folks. This is not scalping. This is a nice intraday swing. It's actually a short-term trade. Trading here on Thursday and then maybe even adding more on the next day, but it's non-farm payroll Friday and the Thursday going into non-farm payroll Friday. So I teach my students don't trade them, but you can study them. But these are typical types of moves that you would see on a medium or high impact news driver day. And what does that mean? Medium or high impact news drivers that you find on economic calendars like Econoday or forexfactory.com's calendar. I like using that one too. It's real easy and follows, all the things that I would be looking for Forex or something to that effect. Yes, everything I'm teaching here works in Forex. It works in commodities. It works in everything out there, okay? The only thing I don't like to co-sign with is crypto. My students like to say it does. I have never traded crypto, so I'm not going to co-sign and say it works there, okay? So there's that. So let's take a closer look and think about how that move right here is the inception, and we are envisioning the trade. How do we do that? What I just marked up, and this is where it's going to draw down to. And this is terminus. I don't care. You don't care if it goes below that low. Who cares? You have to find a way to be able to frame the logic and build a bridge in the unknown. That hard right edge where the market is not yet trading in a new candle or traded in a pattern that's in hindsight now. You have to look at the candle. Like right now, if you're looking at the chart, like right there, what's it going to do next? Well, at this moment here, the only thing I would subscribe to is it's going to go lower and work towards this low here. That's what I would submit to, because that's what I personally believe and believed last week. But this is done. Like that setup is done. So even if you were holding out for something like this low being taken out, in my personal way of trading, 80% of the trade would be off. So that way, if I had to weather any of this type of movement up here to reprice at this area here, I'm not sitting with 80% still on and having all that type of drawdown. Not on a trade that's becoming a loser, but giving up open profits and having that open profit draw down to a lower open profit that could potentially, I could be wrong, folks. This thing they could go out tomorrow and say they figured out the answer to cancer, and all the things of war, the weapons of war were put away, and they found a reason for everyone to be living in peace and harmony, and the market would go straight up. And anything can happen now. I'm not surprised by anything anymore since 2020. But the framework or the way that we envision a price move, or build a bridge from market price to where we think it's going to go, or terminus, which is the draw on liquidity. Where should price reach to? That's the main thing. If you can't do that, you can't trade. I don't care what tells you when to buy and sell. Unless you know where it's going to go, where's it reaching for? Where is the end game? That terminus that is logical. You're not trying to pick the very high and the very low. You're just trying to take out these surgical strikes that make perfect sense. And by having that, you frame that little section like that's here. This is your bridge from here to here. Now, I'm not saying it's going to happen inside these lines. I'm just saying from price to price, from 3,800 to 3,650, we'll call it. That's your bridge. Now, how do you engage it? How do you get in? Well, this is one of them here. That's the inception. And here's another alternative entry here. Now, what's going on in this candle here? Let's go through that. You have a fair value gap, and I know it looks very, very small, but I promise you it's valid. It only looks really little because I have everything on this chart showing you this low here to here. But that is a fair value gap with a bearish order block. Last up close candle prior to this move lower, and a fair value gap. So the market trades up into that, goes up 1/4 of a point into that high. I know that because I watched it live. Trades up into it and then sends it lower into our fair value gap. So that's one setup you could use. That's one opportunity to trade with. That might not be your model. What happens if this isn't your model? Well, now we have the breaker. High, low, higher high. If it takes out this low, it does so right here. Trades up into this down close candle. That's the breaker. It can go as far as that candle's high. Sometimes it can go a little bit more. That's non-farm payroll, folks. It's doing what non-farm payroll does. It's coloring outside the lines. Trades up into the breaker once more, and then it displaces and goes into here. So you might be using this as the backdrop as, okay, this is the inception of the move, but we broke below this low, and then we traded to the high end of that bearish breaker. I'll take that with these stops being taken. And that's your model. But what if that's not your model? Okay. Here is a turtle soup. We have buy side liquidity above this high and this high, relative equal highs. In a bearish market, market rallies above prior to the non-farm payroll and then rejects and trades down into that area here. So again, we're using this as the backdrop. We may not have taken an entry here. But all of these setups, these potential setups, are all taught on this channel for free. That's not your cup of tea? This is, maybe. Last up close candles prior to the rejection here. These last up close candles is your bearish order block. Extend it out in time with the fair value gap. Trade into it there. That might be your setup as well. Now, I didn't do this one for the chart slides, but you can take this swing high to that swing low, optimal trade entry. That's the flagship pattern on this YouTube channel. I guess really that's actually taken the back seat now to the fair value gap model, hasn't it? The optimal trade entry, the OTE, was a long-standing flagship pattern on this channel, but obviously everyone's getting funded and able to find continuity and consistency and profitability with the model that I shared this year on 2022 mentorship, which I'm loving to death. I love that. And that's my daughter's model that she can't use because she's not able to trade. She just can't do it. And I mentioned this before. Sometimes you're going to find that you can't do this. And even if you don't learn from me how to do it, you may try to do other ways and other mentors and other approaches and still not find success. Folks, if that's you, the best thing you can do is identify that early and just stop, because trading is not for everyone. It is not for everyone, and it would be a terrible disservice to you as a listener and potential student for me to sit here and tell you I can turn all of you into a profitable trader, because I know I can't. I know the limitations of humanity. I know my own limitations. I'm not the best mentor. I believe I'm the best trader technically. I don't believe I'm the best mentor. I have the best concepts and I have the best approach because what I teach is the market. This is exactly what the algorithm's doing. This stuff repeats every day, every week. But I know the limitations of me as a mentor. I may not be teaching it well. You may not be getting anything from this lesson here. You may not be getting anything from any of the videos you've ever heard me teach on. And that's just the barrier that, unfortunately, I'm probably never going to be able to bridge for you. Because if you haven't found your way of finding profits on what I've taught this year, I don't have anything for you. And that's honestly, like, I'm not going to tell you to waste any more time. Because if you can't do it with what I taught in the 2022 mentorship model, in those 41 videos, if you don't have the time to put in the back test that, and put the work into doing that, if you can't find consistency, in 9 months or so, trading's probably not for you, because that's the easiest thing you're ever going to find, technically, unless something's spitting out buy here, sell here, and who knows what the logic is behind all that. Now we drop down finally into a 5-minute chart on non-farm payroll Friday. Here is what the lower time frame with time of day, everything comes together. Relative equal highs. This is the same thing you would expect to see on a medium or high impact news driver day. Doesn't have to be non-farm payroll, but I'm going to teach you something really cool with price now. Buy sell liquidity is rated there. Then it trades lower, which is what we would expect anyway. It's also trading into that series of all kinds of bearish patterns that this went through on the previous slide. Before it drops down here, I went through 5 different patterns. So you don't have to have one pattern with me. Understanding where price is likely to turn, where is the inception of the move, and where is terminus. So you're building that bridge in price action that hasn't even started yet. You're anticipating that. That's what this whole presentation is. Learning how to anticipate how these setups form. And as you can see, there's a multitude of different approaches that I teach on this channel that you can use to get into the trade. That's the easy part. Understanding where it's going, that's the hard part for students. They don't know that. And they think they should watch a video, and therefore I know how to do it now because I watched ICT's videos on daily bias, and I watched it on liquidity pools and the liquidity matrix, and I understand the PD arrays, and I should know how to do this by now. No, you shouldn't. It takes time. It takes time. All of you are going to get here at a different time, but you're going to get here right on time for you, because everyone's walking this path at a different pace with different baggage. You have all kinds of stresses in the world, your job, your family, your friends, your work or lack thereof. All those things are going to contribute to this. And they may be a plus or a minus in the whole development process. That learning curve is going to be affected, positively and negatively by other things outside of you. And all of us have that going on. And I can't give you a time frame that's reasonable or what would be a cookie cutter response for everyone, because they're all going to get it differently. So on non-farm payroll Friday, the market runs up. This is a Judas swing. It's a fake rally. Okay. Then it rejects. Now this here, that would look like a fair value gap to the first casual viewer of my channel looking at the 2022 mentorship model. Oh, I'm going to expect it to trade up here. I'm going to show you why you wouldn't. Okay, this is one of those really good lessons. The market shows displacement aggressively and trades down into this area right in here, right below this low. What's below that low? Sell stops. So sell side liquidity. So it digs down into that on the 8:30 news driver at non-farm payroll. Then the next candle opens here, trades up to here, and then starts to work lower here. The next candle trades lower here, and then the next candle opens and trades down below that low. Key information. I'll come back to that in a minute. Then the market comes back up into this little gap. This is a fair value gap. Well, wait a minute. Why does this say it's a breakaway gap? And why is this a fair value gap? I'm going to teach you. The market trades lower. This fair value gap that would otherwise be mislabeled by someone else on YouTube, this is actually a measuring gap. I'll explain why that is so as well. And then drops down into our 36.45 level in here between 50 and 45. That's the fair value gap on the hourly chart. Remember I told you 36.45? It goes into that level and just a little bit more. Well, how do we know when it can go down below the targets? How far can it go, ICT? I'm going to show you that. Just slow your roll, okay? Slow your roll. Get to the point, ICT. Oh, let's do it now. From this high to this candle's low. Why this candle's low, ICT? Why not this one? Why not that one? Why not this one? Because this one here creates a gap. After a run below, the initial run on the news, we have what is a balanced price range. I'll show you that and I'll explain it to you in a minute. But then we have a fair value gap. It trades lower, takes out another low, creates an imbalance. Now, we are expecting price to get down to that 36.45, right? And here's a gap right here on the heels of a fair value gap that was traded up into. When we have another lower gap, right after our fair value gap has already formed, and it's at approximately halfway to where we are thinking price is going to drop to 36.45. Look at this gap here between this candle's low and this candle's high. Look at this here up to this high. If you take that range from this high down to the top of the gap, which is going to be represented by this candle's low right here. And I know this is probably going way over your heads if you're new, but I promise you, study the video a couple times. Come back to this one after a couple months of doing all the other videos. Okay. It will mean much more to you and it'll make much more sense to you. But right now, I'm jamming a lot of things inside of one teaching. But this is what I do when I sit down with somebody and they're really intrigued with what I've been saying and they've got this far and they're still asking me more questions. Because I can talk about this stuff for hours and hours and hours and never get tired. I won't even need to use the bathroom. I'll just simply go on, go on, go on. I am the mentor with a mouth. I can keep talking and talking and talking. But if they're talking to me and asking more questions, I go into levels of detail like this to show them. I'm not teaching them, obviously. I'm teaching you, but I'm showing them these are things that I see in price action. And of course, they're looking at me like, how do you know that? And I'm sure many times I've talked to them, they thought that I was talking about something that's already happened. Therefore, it couldn't be real until I show them a trade that's basically their annual salary. That type of response really gets them, worked up and they're like, man, I want to learn what you do. And suddenly they want to quit their job. They want to go and tell their boss, I'm done. I'm going to do what this guy does. And I have to tell them what I've been telling you this entire video and other videos, that you have to slow down and give yourself a real chance. But I'm deviating, I know. That low is the top of the gap. So if we're measuring a high to a gap that would be potentially a measuring gap, how do we know it's a measuring gap? Is because it's forming right after a fair value gap, right in here, and it reacted to it and sold off. This one here is at the midpoint of where we're looking for price to go to, which is back to square one. Everybody wants to teach how to get into a trade. Precision sniper. I think I'm the one that did majority of the work with precision sniper entry techniques, given that illustrious name of sniper precision. Now everybody just wants to do sniper entries. Look, there's all kinds of sniper entries. Every candle's giving you a sniper entry. But what's it going to? Where's the draw on liquidity? Where's terminus? Where do you pull the plug on, this is how far I thought I was going to go for right now, and I'm done? That's what you need to be understanding is the most important thing. Why should price go to wherever it is you think it should go? Period. What's the draw on liquidity? Where should price be going to? Wherever it is right now, that's market price. We all see that real time when we're looking at the charts. Only seasoned traders, profitable traders, people that are versed in understanding what price is doing, will know where price is likely to go to next. It won't always be a straight line, but where's it gravitating to? Above or below market price? That's bias. That's as simple as it gets. Now, on my Twitter feed, I always point to where my attention is. And if it's above market price at the time I'm tweeting, guess what that means? That my bias is bullish until it changes. Sometimes I'll change it. Sometimes I'll say, okay, well, this, I don't like that. Or I'll put your attention on another level, because that means I'm potentially transitioning from a existing bias to something else that may have changed. Or I'm either taking a trade or I've closed a trade that you don't know about, I'm recording, and then I'm going the other direction. And then a year later on, you see what I've done. So I'm pulling your attention to a specific level. I'm taking your attention to the draw on liquidity that I believe is right now salient, because that's the skill set that all of my students need to learn first. Well, the first lesson is patience, but nobody learns that right away. The draw on liquidity, where price should go to next, that is the most paramount fundamental lesson that every student of mine needs to grab a hold of. Because if you learn how to determine that, if you do that, bias is easy, and you'll be able to submit to these trades panning out. Because if you don't know what it's going to reach for, and you don't have the confidence to hold on to it, you might be in a trade that's beautiful. You have nailed down a perfect entry next to zero drawdown. And then because you don't have any trust in what it is you're expecting to be a draw on liquidity, which is why all of you want me to do these live sessions and streams, because you already know that if I'm pointing to a specific level and you see me get into a trade, it's going to be real easy for you to hold a trade that way then. And you're all smiling saying, yeah, let's get it. No, we're not doing that, because to do that makes you codependent with me. And I want to cultivate independent thinking, so that way you're doing everything independent on your own. You're not requiring me to do anything for you. And there's no way to shortcut that. Yes, you can all be piggybacking on me and making money. That's not how you learn. That would piss me off, to be quite honest with you. I don't want to do those things. I want you to learn how to do this and then say, you know what, ICT, I appreciate everything you've done. I don't need this anymore. I don't need you to hold my hand anymore. I don't even need to watch any more videos anymore. Thank you, brother. I'm off. Boom. Blaze a trail. Keep up, and let me know how you're doing. That's the relationship I'm trying to cultivate with all of you. I'm not trying to create marriages with all of you as student and teacher, and I don't want that. So if we can measure the high to the low of that candle, which is the top of the measuring gap, project that down, you see this level here? That's one standard deviation from the high to the top of that gap right there. That candle's low right there. Because it's this candle here that makes the fair value gap typically, like it did here. But we don't want to see that close. What do you say? Yeah. How do you know when certain fair value gaps are going to close completely and when are some of them going to be staying open? Hello. Told you. It's not made up. It's not contrived, folks. It's a logic behind all this stuff. Everything is engineered with a purpose. And all these yahoos out there trying to run off to Amazon and take all my mentorship stuff and make books out of it and not credit me or mention me at all. That's the poor man's approach. You don't know what you're doing. You don't have any logic behind it. And anything I've ever said, if you repeat that in a book that you type up and plagiarize, that doesn't mean you can do it. And you're stealing credit that you didn't earn. And that's why I've been teaching for free this year. A lot of young men and women have gone out there and tried to pretend that they created this themselves or that it's Wyckoff. This is not Wyckoff. Nothing here is Wyckoff. Wyckoff can't get this precise. Sorry to break your heart. But we have that level right there pointing to where the bodies of the closes on this candle and the open on this candle. Beautiful delivery. So yes, it went past 36.45. That's fine. But how far can it go? It can go down here. But I would be getting out around 36.50 or just below that. And that's fine. Well, why not ICT if you're so precise? Because sometimes I've had limit orders simply just not get filled. That happens, folks. I have trades where I'm in open profit and I can't close them. Okay. They wouldn't let me close it no matter what I was doing, period. And I had enough leverage. I had enough equity. I had enough everything. I've done larger positions and the broker just simply wouldn't close the trade. It happens. So I want to get the low-hanging fruit. Low-hanging fruit would be 36.50 for me. It's a nice 50 level, done. I don't need to go down here to this level here and feel good. I'm feeling good once it gets down to 36.50. I'm done. See you later. Have a nice day. You can hold to get down here and get out there. I'm not trying to be that precise. I'll take the glory of saying I think it's going to go to that level, but I do that a lot on Twitter, and I'm exiting early. And I've been very candid with everyone. My weakest part of my trading is my X's because I want precision and perfection all the time. But I know my humanity prevents that. I know it does. So I've created the low-hanging fruit approach where what's the highest probability exit that's very close to where I think it's going to go and the strategy that's going to be employed to do that over and again and not have to cause me to overthink it. And that's what I teach my students. Period. I'm sure if the Lord graces me with enough life in me, I believe that my private membership group students, one of them will come up with a phenomenal exit strategy on the things I've taught. And I'm not opposed to taking that and learning from that. I'm flexible in that regard because that is my only weakness. But that's the only thing I would look to improve with someone else's help. But it would come from my students, not somebody else. The logic, the things that I do, that's where I operate. I don't care what anybody else is doing. I don't care how much money they make. I don't care, what they say, what they believe, who trained them, what bank supposedly they worked for. I got bank traders that are in my students. Okay, so I don't want to hear about all that. Okay, that type of stuff that's outside of what I teach, I'm not interested in that. But these things repeat, and there's a logic to it. But now, while we're on the subject of gaps and why this doesn't get traded back up into, because it's a measuring gap. Measuring gaps tend to stay open, just like a breakaway gap does. Why is this a breakaway gap? Because we went to a level of buy-sell liquidity, and then it took off, went lower, and this is going to stay open. When this low is taken out with this candle here, and then we close there, and we open, rally up a little bit, and create that gap. Once price trades down to this low here, on that candle, Now we have another shift lower in price. So because we went below this low here and we went below this low here, high impact news driver, this gap stays open and we anticipate that staying open. We're looking for it to stay open. It's going to act as what? A breakaway gap. Why? Because the likelihood of us trading down to 36.45 is where we were anticipating price based on that hourly chart. So if we see this remain open, that's stage one. We have a lot of things in our favor if this stays open. Then when the market creates this fair value gap here, after this low is taken out, if it trades back up in here, we can take that as a short. Because this low to that high, that's a balanced price range. That's balanced. Why? The market traded down, then back up, then left that range with that low right there taken out there. So it moved both directions and then left it. It went down with this big candle here. It went up here and then down again. So it doesn't need to go above this fair value gap at all, let alone get up in this area. So this is your short after non-farm payroll. You can't get in here. I don't care what anybody else says. Unless you entered before 823, 825, the chances of you really getting a good fill is slim to none. Can you have done it? Sure. The likelihood of all of you getting filled, no. Because the brokers, they pull all the liquidity. They just don't let you get filled, period. There'll be mentors out there that say, oh, there's an absence of buyers and sellers. No, there's a whole lot of wanting to buy and sell. The brokers are simply not going to let you. That's the dirty little secret. That's the thing that everybody knows is going on, but they all just want to stay within the herd and sound like everybody else and not be the outlier. Okay, the person on the outside that really knows what's going on and speaks their mind. That's what I'm doing. They're not going to let you get filled, period. You think that everybody out here in the retail universe, as far as trading goes, they see these big moves in non-farm payroll. You don't think there are willing buyers and sellers? They all want to do something. And there's a lack of what? Liquidity? Nah, that's bull. It's the brokers keeping you from getting filled on these big moves. They don't want to be on the other end of who they place trades against because they might lose. A broken clock's twice, right? Each day. And the likelihood of thousands potentially of being right on an over leveraged position and they are booking them, it's much easier for them to simply just pull all of the ability for you to put a trade on at all. You can't get out. You can't get in. You can't add. You can't adjust your stop. It's just ain't going to happen. That's typical with non-farm payroll. That's typical with FOMC rate announcements. Okay. And that's the reason why I tell you don't try to trade them, folks. You're trying to do something that's next to impossible, even for me. So if I got 30 years in this, and I feel like I know what I'm doing, if I can't get a fill, why the hell would you think you're getting filled? And filled favorably, okay? See these guys out here, they put a buy order and a sell order. Whichever one gets filled, go with that. That's nuts, okay? Because literally, non-farm payroll, its classic delivery is whipsaw. So it knows that traders bracket above and below. And traditionally, the first move is fake. Like you see here, that little Judas swing right up there. So we have a gap opening here with a fair value gap, but it's not a fair value gap. It is a breakaway gap. It's breaking away from this liquidity run, taking out that low here. And then we have price trade down to that low, then it closes here. So what has it done? It's traded down and then back up. See that? Then the next candle we open, we rally up a little bit more, and then we go right back over top of that candle's range. So as soon as we take out that candle's low right there, that makes this low to that high balanced. That's a balanced price range. This is not rebalance when it goes back up into here. That is not a rebalance. That's not rebalance, folks. That's repriced. It's just simply repricing back to this area where it's lacking buy side delivery. Sell side is what you see here. It's from this candle's low and that candle's high. That is sell side delivery, and it's lacking buy side. It's delivered buy side here. Then it leaves it. Now, this range low to high, once it trades down below this low here, it's bounced. Why? Because look what it's done. It went to this low, rallied, went back down, and then back and forth in here, then left it. This is a balanced price range. It's no need for it to come back up above here to take out stops because it's a balanced price range and it went to fair value. And nobody could have moved any stops in this movement here. So no one got short. So there's no reason for them to think, okay, it's going to run up here and knock those stops out. See the logic there? So think about that bridge analogy. If you're building a bridge and you're trying to cross the bridge as the bridge is being built, okay, there's two types of things that are going to occur. One, they're going to build part of the bridge and leave a hole that they got to come back and fill, which is a fair value gap. Or they're going to work until they run out of material, get as far as they can, and then come back to the other side of the bridge to get more material to go and start building more of the bridge. What would that represent? That's a stop hunt. You don't need them to start the bridge building here, then come back, fill in the fair value gap, start to move lower, and the end of the bridge or the other opposing side would be down here. You're not going to expect them to come all the way back up to knock out stops to get more material to make that bridge efficiently delivered to 36.45, because this here was moving too fast for anyone to get short anyway. So there is no short holders here. That's the whole reason why it did what it did. Nobody was allowed to get in it. So there's no necessity for anyone to assume that this has now trailed stop losses, because all of this work here was so sudden and harsh that really there's no liquidity above that high. It was just returning to fair value gap there. Then short sellers came in the marketplace that were considered smart money. Then it drops. Why is it that certain highs don't get ran out? I just told you. You have to have a premise behind why it should or shouldn't happen. That's narrative. Everything you see here, nobody got short in that. They couldn't. In less than 1 minute, folks, the S&P moved 40 handles plus. And you want to trade non-farm payroll with very little experience? You're just playing Russian roulette. You can lose more money than you have in your account. Why even risk that? So, I could talk and talk and talk and build so much more on this whole thing here. But the whole premise to this teaching I have, in my opinion, delivered. Looking at price, trying to determine where price should draw to next. That's how you build a bridge. Okay, when they build the blueprint for a bridge, they have a design based on an area they've already done a survey on. What's the survey doing? They're looking through transits. They're getting measurements and distances and such and heights. But they're looking at a specific location. Point A to point B. Not point A, point C, point D, something else. Well, if we don't like this movement here, we'll build a bridge over here, a little bit different angle. That's not how that works, folks. When I'm trading, it's the same way. I'm looking at a particular draw on liquidity. I'm not looking for plan A, plan B. I'm looking for a draw on liquidity. I am aiming with a directional mindset. I have a bias. I'm not wishy-washy about it's going to go up or go down. It's going to a specific location. And I'm going to submit to that until I'm proven I'm wrong. That's what you have to trust. And you only do that because you've done back testing, then you've done forward testing. And you did tape reading and you studied without putting any trades on, not even demo. And then you grow accustomed to seeing these things form over and over and over again. And you lose that desire, that impulsive nature to go in with live money because you just want to get real money out of it. If you feel like you got to rush to live trading, I guarantee you, folks, this is the easiest rule to know. If you feel like you got to have a live account to trade right now, wherever you are in your development, if you are just impatiently can't wait for that live account to get opened up, I swear to you, you are not ready. You're not. The easiest way of knowing that you're ready for live trading is when you are so bored doing this over and over and over again, and it doesn't matter to you if it pans out, but you're consistently finding the right side, and you're managing your demo, and you're managing your expectations, and you don't feel excited when it goes there, and you don't feel fear when it's not moving right away for you, or if it stops you out and you don't feel it's failing. If you're indifferent about doing it with a live account, but you know that's just the next step, that's when you're ready for live account trading. Anything less, I guarantee, I don't care who tells you otherwise, you're going to open up a live account and you're going to blow the account. Period. End of story. Guaranteed. I promise you that's what's going to happen. I understand being excited. I understand being enthusiastic and optimistic and feeling like you got it together. But if there's any shred of emotion about rushing into that, I promise you, you will remember what I just said, and you're going to be thinking, man, he was right again. And I don't want you to have to do that. At least not that instance. Every other time I like it, but I don't like it when it's like this because I'm trying to spare you that. You want it to be boring. You want it to be really dull and boring. You don't want it to be a fanfare, an excitement or a party fever because you're going into a live account. Because if you're bringing that emotion into it, I promise you that's going to weigh heavily once you push the button for real. And I don't care what leverage you use. It's going to feel like $1 million is on the line. And you can't trade like that. Scared money will not make money. You're not going to be consistent. You're not going to follow the rules. And why do it if you're not going to do what you're supposed to be doing? If you can't follow the rules and you can't be disciplined, how are you going to measure your results meaningfully? And how can you really accept profitability when you're doing it like that? If you're not following the rules and you're just, willy-nilly, just go with your gut. That's not what you trained yourself to do for months. And you have to submit yourself to that same approach. And if you do that, bringing emotions in, you're cheating yourself. And I don't want you to do that. I want you to do very, very well. And you can do exceedingly well, much more than you think you can right now. But you have to give yourself the chance. And I promise you, if you do it the way I'm teaching you, you stand a far better chance of success than having never done anything I've taught. Hope you found this one insightful. Until next time, be safe.